So, like all good moderators, I will start saying that the panel needs no introduction and then go ahead and do some very brief, quick introductions. Or I think the moderator needs more introduction than the panelists, considering that, all of you guys are fairly active industry participants. The concept of this panel and this entire conference was more targeted at the mutual fund industry. And as a result, we tried to get panelists who had a lot of grounding in that. So, Venkat, so you chose yourself. Yeah. So Venkat is a veteran of industry. Last job prior to this was as DMD of State Bank of India. Can't get bigger than that. Is the corpus at SBI, have the mutual fund total corpus caught up with SBI's corpus yet or no?
Of course.
It does.
Only thing is in 2015 when I was heading the treasury, the total corpus of SBI was around 12 lakh crores and the mutual fund industry AUM was around 10 lakh crores. But I'm very happy to see that the way in which we have progressed to 67 lakh crores as we speak now.
Fabulous.
And SBI mutual fund alone has crossed 10 lakh crores.
Of course. It's 12 lakh crores, I thought, at last count, and
That's right.
has become the largest for a while. So thanks for being on the panel and look forward to interaction. Amit Tripathi is head of CIO at Nippon Mutual Fund, fixed income side. And I have some association because when I kind of got my retirement funds from BNP Paribas, much of it went into Nippon Laksha Nivesh. And I've told this to him as well before. And I think for all of you guys who have are close to retirement or need to plan retirement, do look at that particular scheme because I think that's the only one which gives you a really long duration. Otherwise, you really struggle to find something like that. But I think that's that's an unfair introduction of Amit because he's been 25 years now almost with Nippon, right? Right from the start.
21 with Nippon.
With Nippon and 25 industry-wide, right? And Amit, of course, is a hardcore fixed income guy for that longer period. So again, he chose himself as to come on this panel. And thanks for coming, Amit. Look forward. And I think now the portfolio is also up to 1.5 lakh crores, right? Practically.
Yeah.
Roughly. So great. Thank you again. Rohit comes as well. Latest assignment is at NSE, where he's head of investor relations. And I also read, Rohit, that your focus is on digitization and partnerships, right? So it was good to see that. And we will talk some about it because that's an important topic for Harmoney. It's almost existential. So thanks again with the introductions. I'll move on. On the topic, which you can see on the screen, driving digitization. Sorry, the topic's not there anymore, is it? For the panel? Okay. So I can read it there. Right, growth, liquidity in Indian bond markets, right? So, and my introduction, they've just written advisor, but I'm supposed to be senior advisor at Harmoney, all right? So it's one of the assignments that I do in my post-executive life, like I was sharing with Mr. Venkat. I do a few others as well, but Harmoney is really dear to my heart. And nowadays, I think wherever I go, senior gets automatically added to as a prefix. It's got to do with my age, I think. So anyway, this is something I've really enjoyed doing because, like, again, I was discussing earlier with Venkat, over the last few decades, we've been breaking our heads on how do you get fixed income markets to develop more, how do you get more liquidity in, how do you get automation done, how do you get retail in, etc. And I thought the key objective that Harmoney has kind of coincided with what we've been trying to do. So it was exciting, and so here I am. Right. I think without further ado, let me turn and start with order of seniority. I'll ask Mr. Venkat. You permit me to just refer to the note. What we've seen happening in corporate bonds, and intentionally we didn't make this a fixed income discussion, more a corporate bond discussion, because if you do a fixed income discussion, then government bonds are a different kettle of fish altogether. So we could end up sitting here till kingdom come. But just for corporate bonds, over the years we've seen fairly significant increase in liquidity in inverted commas, but of course in volume. So you see about 6,000 crores per day, and Rohit nods because much of it is on the NSE, which is good in a way. But my question to you and the other panelists would be in due course is, what do you think? Is this liquidity real? Is this good, bad? What are the issues with this liquidity? Like to get your thoughts.
Yeah. First of all, thanks, Manoj, and I'm sure you don't need any introduction to these people because you are one of the persons who's in the treasury markets for quite some time. And thank you. We know for right from 2008 onwards, I know you so. And secondly, thanks to Aditya and the entire team for making me a part of this panel discussion. Coming to the point that you talked about the growth in the corporate bond market, the growth is quite significant. If you look at the way in which the corporates are issuing the bonds, and if you look at the last 3 years, the corporate bond market has grown almost by around 21 lakh crores, which is somewhat equivalent to the growth in the corporates loans given by the banks to these corporates. So almost neck to neck around. If you look at the growth that has happened, it's almost the same which is grown in the bond market and this loan market. To that extent, the growth is quite significant in the bond market. But if I, looking at the numbers that you talked about, 6,000 crores, we are mostly into the GSEC market and all, which has got almost around 210 lakh crores or 215 lakh crores is the total number. But if the secondary market through NDS home which we are all familiar with is almost around 70,000 crores. That means around 30 basis points or 3%, 30 basis points is the total turnover that's happening. Here is a corporate bond market which has got almost around, as I said, 50,000 crores is a total outstanding that as you speak now. 50 lakh crores is a total outstanding that you speak now. They have got a turnover of only 6,000 crores. It's hardly anything. And second important thing that we would like to bring to your notice and to the notice of everyone is that this turnover remains stagnant from 2018 onwards. When I looked at 2018 turnover, it was almost the same, 6,000 crores, and as you speak now, it's all the same. So the turnover has not gone up. And what are the reasons for that? We need to analyze what reasons are that. And this is something that we keep talking right from, at least from the time that, not from my treasury days, from 2006 onwards, we participated in various panel discussions, did talk about these things. And one of the important things that we always talk is that the market, both the investors and the issuers are only AAA and AA rated corporates, and that too because the others are getting a better priced, and there are other reasons we can discuss as we move forward. And the investors who are investing, they're all held to maturity. Very few of them are traders. So that's another reason why both the players and if the investors, on the both sides, there are few issuers and there are people who are investing are holding to maturity. There is no retail participation that we look at, although we'll move forward and discuss on that. And that's the reason why the liquidity in the secondary market, although it is 6,000 crores, to my mind is very insignificant and needs to grow.
Thanks for that. Is it working? Okay.
Yes.
We will indeed, circle back on your closing point. But Amit, to continue the discussion from fund manager stroke traders perspective, and I love talking to traders because that has been my first love. I've always been a trader. What do you think are the issues with this liquidity, and what would you like to see improved as far as liquidity is concerned, and why? Why those things are required? If you could give your thoughts on that.
So I actually took 2 minutes before coming here to jot down 11 points. So
11 points, and thankfully we didn't give you 1 hour.
See, you ask any guy, like sir said, that there have been, I think, 2,000 panels in the last 20 years and the issues have remained the same. So that's why the points come very easy. But let me start by saying that I think I completely agree with sir that liquidity is pretty inadequate as far as corporate bond markets are concerned. Not only is liquidity inadequate, price discovery is extremely difficult beyond a particular threshold, either in terms of rating or in terms of structure. And the third is that there is no incentive to trade, which is the biggest problem in terms of secondary market liquidity. Buy and hold is a problem that is not only afflicting corporate bond markets, but I think increasingly afflicting government bond markets also. And I think the nature of investor globally and in India specifically has changed in the last 10-12 years. Market making is dead, and there is no incentive for that. So if you want liquidity, you have to build incentives. And what are the incentives that I can think of, right? So if I were to structure the market completely blue sky, which I know is not possible, okay, on day one I would say there should not be any difference between loan market and bond markets when it comes to pricing and valuation. That's not possible. What is definitely possible is at least within bond market you should have uniform valuation. I think today, even within banks and mutual funds, forget insurance companies, pension funds, provident funds, which are by definition more often than not hold to maturity investors. But even within banks and mutual funds, there is a huge difference in terms of valuation of the same ISI and of the same issuer. Okay, unless you have covered that distance, the incentive for me to sell might be there, but what is the incentive for a bank to buy if his valuations are completely different from my valuations and vice versa, right? That's point number one. Point number two, because unlike GSEC, so what was the biggest two drivers for GSEC markets to be liquid? SLR is a buy and hold requirement, right? It is not a liquidity requirement. So I just buy and hold, that does not create liquidity. What creates liquidity in the GSEC markets is repo, right? A player who has 10 rupees in his pocket can actually hold 100 rupees worth of GSEC because he has a repo facility. We have started with a repo facility, and to be very honest, I think some of the things that regulators have done in the last 18 to 24 months, the heart is in the right place, but somehow the things are not well oiled enough, or there are a lot of cracks which need to be filled up, right? Take ARCL for example, brilliant idea, brilliant thought process already put in place, but given the balance sheet size, they can only do that much. And given the pricing around the repo today, there are half of the market players who are not interested, half of the market players whose risk matrices don't allow them to trade, and half of the market players like mutual funds who are slaves of day-to-day liquidity, right? So just address these 2 points to start with. I can speak about the remaining 9 points, but time will not permit. But these 2 points, which is uniform valuation and a very deep, thriving, functioning corporate bond repo market across rating, across structures. Do these 2 things, you will create traders in the market. Because today, historically, the guys who used to do money market making, which is banks, primary dealers, they don't have incentives. Their balance sheet structures have changed, their regulatory requirements have changed. They cannot do this even if you want them to do this. Players who can do this, for example, most of the intermediaries in the equity markets are not banks, right? So you need intermediation. That intermediary has risk appetite, but he does not have capital. Provide him the capital with repo markets, you will see a lot of liquidity improvement. So these are the 2 points. I have 9. If you want, I can.
No, thanks. I think you made the 2 critical points. And on valuation side, we've struggled so much. Honestly, I've been part of 100 committees at FIMDA when RBI used to be behind us on corporate valuations because banks particularly really struggled, and to get a true value of their books was very difficult. The other challenge, Amit, is that how do you get a uniform valuation for a corporate bond when different banks lend to the same company at different rates for different tenors or whatever, so it's really very difficult, and you find low rated companies getting excellent rates, and like you rightly said, everyone treats corporate bonds as loans, right, as far as banks are concerned. So this valuation is a cussed kind of issue.
No, but I don't think this is valuation. Sorry if I can just take this. This is about transparency. Valuation forces transparency. The moment you become transparent because of valuations, you will automatically mend things that you are not doing right today. In the post-COVID environment, mutual funds have struggled to lend to A-rated corporates because the A-rated corporates were being lent at rates which were not even available to AA rated corporates in the capital markets. Okay. So if you have that kind of a tendency, obviously you are creating a rift between the markets because one player is not concerned with where he is lending and the other player is concerned because he is getting valued on a day-to-day basis. But that's a blue sky thing. You can see equating loan markets and bond markets is a very, very distant wish list, honestly. Let's equate the bond markets first. That itself is a job well started, right? And then we can think about the loan markets going forward.
Absolutely.
And second thing, Manoj, if you look at talking about loans and bonds, you have the relationship. When the interest rates are coming down, I mean, you look at I'm talking about the major picture. When interest rates come down, most of the people flock to the bond market because markets will be leading and then banks will be lagging. So people who are accessing to the loan market come to the bond market. And when the interest rates keep going up, it's a reverse. Immediately they go to the banks because there's a lagging effect and the markets go up. So that's one reason. And of course, you have a provision requirement in respect of the loans, whereas there is no provision requirement, only the mark-to-market in respect of this. Third, the banks, if I invest in bonds as a banker, I'm not only taking a credit risk, I'm also taking a market risk. And therefore, the banks would not prefer to invest in the bond market, although they do it, but not on a large scale. I'll stop here.
No, agreed. So Rohit, what emerges is again, issues relating to liquidity and the fact that, we'll take advantage of your being here and hear out what your view is on, your existing corporate bond liquidity on NSE, BSE, etc.
Right.
And what is, what do you think? Is it okay? We know what the issues are. Is NSE doing anything about it? Can they do anything about it?
Right. So see, like two stalwarts have kind of covered most of the points. So I'll take a little different approach in terms of how I think, and like he said, if you were attending a FIMDA conference or any fixed income conference, the topic would be the same. How do we do that? And there's a joke in FEDI as well that you always talk about dollarization of rupee in 2000 also, in 2024 also. Okay. So now, like both of them said, in terms of what is the incentive for anyone to trade corporate bonds, right? And how do I ensure that he or anyone who wants to trades it? Okay, so at an exchange level, and we think more from a market infrastructure institution perspective in terms of is there ease of execution? Is there availability of access to people who want to trade? Is it available to all? And if I get a perspective in terms of how equity markets have done, who are the ones who've gotten that liquidity? It's the retail participants. This market is largely concentrated between 5 to 7 banks, right? And this kind of gets validated from the point that though the issuance has kind of grown multifold in the last 10 years, the average liquidity daily is only 6,000 crores. Okay, so no new participants are coming. So where do you get the participants from? And traders, and I've been a trader almost 17 years. Traders are the most laziest of fellows. Once they know this is the illiquid market or inefficient market which can get me 2 paisa or 2 rupees more than, and they have no incentive to trade. So what I'm trying to say here is in terms of NSE 1, obviously we have the RFQ platform. We have about 30% of the total trade that happens here. We've seen a phenomenal amount of growth in the number of trades. So it's about 15,000 trades that happen almost every month. Once the face value of those bonds have kind of gone back to 10,000, and we see a lot of retail participants. Now, where is the problem? The problem is that though most of the platforms, like the OBPP platforms, we have now 15 active OBP platforms, which are basically catering to retail participants, and 25, 26 registered OBPPs. Everyone is able to sell it to the retail participant, but when the retail participant wants to sell it back, I mean, there is no market. So is there, so from that perspective, what we're trying to do is we kind of breaking it into parts. Okay, so one, is there a platform that is easily accessible? So, first we did is we went to all the institutions and say, okay, you're participating. How can we increase your participation? Because, JP Morgan index inclusion has happened, Bloomberg Global Ag or emerging index has happened. They said, your platform is the most uneasy platform that we can access. So they said, okay, what do you want? So they said, okay, we want fixed APIs. And so then we went back to market access, Tradeweb, Bloomberg, Aladdin, and likes, and we said, okay, can we integrate it to fix? Because they said, okay, I'm a global manager. I don't want to log in 20 times for different accounts. I want one account. So we introduced a broker model. And then we said, and obviously we, as an institution, we went to the regulator and said, okay, these are the wish lists of participants that you kind of implement. They will participate more. So as an exchange, I think my RFQ platform is pretty transparent. We are doing every bit in terms of API connectivity. In fact, now when we talk to almost all people, there is an API link that is there. We've integrated it to something which is called Cogency, which is a terminal which is owned by a company which NSE owns. I was talking to some of the participants here. They are trying to integrate it through them. So that access we are providing. What we are also hearing, and this leads a little drastic changes, when the market participants don't have an incentive to change, and we've seen that for 30 years, is there something drastic that the regulator has to change? So if 25% is mandated for mutual funds, should it be 50%? Should it be 100%? Why do you see so much liquidity in equity? Is because everything is, if you IPO, whether you're a small company, big company, large company, you have to. But in bond markets, if you are below 50 crores, if your issuance is lost, you can go private, right? So hence, if you go step by step, you take some drastic measures to train how market participants will trade, which will come from the regulatory side. I think then you probably may be able to address that liquidity. Otherwise, it will become a private placement, 5 banks trading, and then probably 2030 we'll discuss the same.
No, yeah, that's useful. Just the one point which came up earlier as well, which is retail participation. Unfortunately, that's not how global corporate bonds or bonds in general trade also. We know that. And at least in India, we've been fairly successful. That via the mutual fund route, at least there is fairly significant retail participation. Unfortunately, it remains a quasi-retail market. Even what you were talking about, the OBPPs, etc., they tend to be the PAFs and pension funds at the other end.
Right.
It's very rarely that you actually get hardcore retail. Having said that, we've engaged a lot on trying to get retail into even government securities.
No,
but those efforts have never been very successful.
So just to that point as well, see, our equity market is very different from how the equity market is in the US, right? So we might want to associate ourselves and align ourselves to the bigger markets that are there, but it might be more value to be different, is what I'm trying to say.
So just to circle back on earlier points, he mentioned to a certain extent, and I'll get back to Amit as well, but from your point of view, any specific recommendations, what can be done to get real liquidity?
See, one of the important things that happens in the equity market, because you see the growth in the markets, is basically the speculators are there. See, any market to develop, you need speculators. If you don't have speculators, no market is going. I take a view that interest rates are going to go up, or I take a view that interest rates are going to go down, or anything for that matter, then there is a price discovery, people are going to participate in that. Unfortunately, as I said in the beginning of my opening remarks, here the investors into this particular bond space are all the people, most of them are holding to maturity. They're not speculators at all. And of course, the problems that Amit had really very clearly articulated about the different valuations, bankers would have no interest, all those things are important. But while we need a common valuation, we need speculators to come into this market who can take views and then give direction to this. That's one. And second, as far as the retail participation, you're right, absolutely bang on when you said mutual fund industry is doing quite a good job, be it in the form of issuing the schemes which are open-ended, and also index bonds and index that we are issuing, index schemes, and then we have ETFs also. All together, if I sum total it up, it works out to something like 5 lakh crores. 5 lakh crores out of this 50 lakh crores is what we have. There's 10% of it. But having said that, we are doing a great job in bringing the retail investors into this particular space to invest. But one important thing that I have taken up with the government of India, you would have seen in the papers also, is that the long-term capital gains, in respect of equity markets, there is a long-term capital gains. Government is incentivizing the people. When it comes to the fixed income, the government withdrew the long-term capital gains benefits. And second thing, the indexation which was there is removed from the retrospective effect, not at the prospective. So two things have happened. We have taken it very strongly with the government of India, saying that yes, corporate bond market needs to be developed. We need to bring the retail investors into this particular space, incentivize these people to come into this space, because by giving some tax relaxations, so that the way in which equity market developed, the bond market also can develop. I'm sure the government is heard us, and on 1st of February, something is likely to happen. But then yes, we need more and more retail investors, and that space has to be filled out.
Absolutely. Thanks for that. Amit, your 2 points. Any specific thing, whom should we ask or whom should we say that this needs to be done for these 2 things to happen, from what you just said in your earlier remarks?
No, you know whom to speak to, right? You don't ask me whom to speak to. So corporate bond repo is already started, right? It's just that half of the people don't know, half of the people are not interested, and half of the people are not eligible. So the entire equity market works on the concept of margins. The bond market should work on the concept of margins, right? Which is what a repo market essentially does. The problem again is cost structures. So for example, I'll give you a typical problem. This is a very real life problem, okay? ARCL has been very, very keen to increase volumes. We have reached 1,000 crores per day, etc., which is all fine. But 1,000 crores is minuscule in front of 50 lakh crores, as Sir mentioned. If you go to a bank today and ask him, why don't you come to the corporate bond market for refinancing your own corporate bond position, the first answer you get is that it's costly. With repo rate at 6.5% and weighted average bank cost of funds below that, no bank is going to justify it unless you have a separate cost center within a bank, right? But again, those are teething issues. I'm not really interested in getting a bank or insurance company or a PF to come and repo their stock out. They don't need to. The retail investor has to be able to do that. The trader has to be able to do that. The intermediary has to be able to do that. The mutual fund has to be able to do that. So if these 4 guys, and the corporates, there are a lot of corporates today who are holding bonds, they have to be able to do that. Allow seamless entry into the corporate bond markets. Providers of liquidity are enough and more, right? If GSEC repo is giving you whatever 6.5% today, you introduce a corporate bond repo at 7%, there are enough and more takers, especially if you have a guaranteed platform, right? Today you have a quasi-guaranteed platform in the form of ARCL. It's not guarantee, but it's actually guarantee there, right? Because there is a backstop. So you introduce that platform, make it much wider, make it more accessible. I think in a very, very tangible future time frame, say 2 years, 3 years, 4 years, whatever, you can see a sea change in participation if you just allow people to refinance themselves in that market. Because otherwise, nobody is going to put 100 rupees out of his pocket and trade. No trader in the world does that. Why would I do that for corporate bonds? I need to get refinancing, which has to happen. But since we are in a Harmoney setup, and let me just bring in this retail versus institutional debate also. See, today the problem is also that one segment is not able to access the other segment. For example, if a retail investor today wants to buy a bond, and one of the things that happened in the post-COVID environment, जो कि हमारी गलती है, we all started thinking that retail investors had lost risk appetite. Actually, mutual funds had stopped providing risk. Retail investors never stopped risk appetite. In fact, the risk appetite only grew. But the challenge here is how do we integrate these two systems, right? Today, within the infrastructure that you have RFQ, you have OBPP, you have the retail platform for NSE and BSE, you have the phone market, you have direct trades. These 5 things are working parallelly. They are not interacting with each other. 9 out of 10 times, either that will lead to lower volumes or that will lead to poor price efficiency, because it then becomes a siloed market in which the price efficiency is not transferring through. So it is a dying necessity that this market, see, even today GSEC markets, not everything happens on NDS home, right? SDLs still today are completely outside NDS home for whatever practical purposes. Even T-bills are outside NDS home for many practical purposes. But whatever market there is, it is because all the players are able to access it in a similar manner at the same cost, right? I think we have to do that in the corporate bond market. So if it is RFQ, let it be RFQ. Then every player has to be there. You can't make the RFQ platform eligible for one set of participants, not for the other set of participants. Similarly, if it's the exchange platform, let every platform. He spoke about equity markets being very different than debt markets. What is the difference? The difference is that in equity market, everyone uses a member to access the exchange, right? You can have the same infrastructure in debt markets also. You can have a member who is fronting you. You have a transparent, anonymous order matching system. Whatever platform you choose that and go ahead and do it. I think the infrastructure is in place. Like I said, the intent is right, the heart is in the right place. There are a lot of cracks. You just need to identify and fill those cracks.
No, that's the reason I asked for specific is, I don't want to waste all of your time, just doing a panel discussion again 20 years later, same thing, right? So I will put together concrete suggestions and write to both RBI as well as SEBI once we have a, kind of agreement at the end of it. So that's the reason I asked. Now just moving on, because we spent a lot of time on liquidity, I think the other issue which as we should, as a part of this panel, discuss is, we have had a market which is kind of quasi-telephone still, even in government bonds, and of course in in government bonds, you may say to a large extent with NDS home, it is indeed electronic largely, but as far as corporate bonds are concerned, it's still RFQ. Most of the trades done offline and then have to be reported or dealt with, etc. We all know that, right? So my question is, to you, Mr. Venkat, first, having seen how NDS OM evolved, how corporate bond trading has evolved, and certain regulatory mandates being forced on the market, respective markets. What do you think is the answer? Is it going to need a kind of regulatory thing to get it really genuinely electronic? But before that, the prior question is, do you think it is important that it should become, is one of the answers for getting more transparency, more liquidity, etc., is to have more electronic trading rather than, this quasi-telephone thing, which, and I think I'm one of the only traders who survived 92 scam and still around. So I've seen all types of trades happening, and I'm the last one to. I was amongst the last one to give up on telephone market because it obviously gave a lot of advantages to traders, right? So, question is, you think it is good to move to evolving electronic kind of system entirely, or bad? And if it is good, I presume you think so. Then what do we need to do to get there?
And absolutely. I mean, there are no two opinions about it. For a better price discovery, for transparency, as you rightly mentioned, we need to move towards the electronic platform. There is no two opinion about it. But having said that, NDS home and all of us successful, because there are risk-free assets. People can boldly put up what is my total security, how much exposure I have, how much I'm willing to sell. All those things can be clearly mentioned there, and it's easily picked up by anyone. Disclose your name or no disclosure. That's no disclosure at all. But in respect of corporate bond, what happens is, even if I don't want to disclose, I don't want to show what is my total portfolio of a particular corporate. Those things will have to be overcome when I'm going to start on the platform. These are the small things though. These are very, very small things. But as a trader, the moment I try to, because when we were overseas, in fact, we used to do trading on the corporate bonds in dollar markets. And then we used to put 2-week prices there. We were putting there because we were confident that there is a market across all these segments, be it AAA, AA or BBB or whatever. Here it's not so. So I would think twice to disclose my book here, whereas in the case of G6, there is no worry at all. That's one. But having said that, this is extremely important, and retailization, sachetization that we are looking at, if we are going to do that, it's definitely going to improve. Platforms like your Harmoney and others are going to help in bringing this market.
Thanks. So Ramit, same question to you. You want me to repeat it or? So just, what I was asking him is, we've seen government bonds evolve into NDSO, largely electronic, reasonably so. You think for corporate bonds, for that to happen, is it healthy? I mean, not as a trader, but obviously as a, what is good for the market. And do you think if it is healthy, then, what is the way forward? Are there any suggestions there? What should be done to get it more electronic? Or is it got to be ultimately a mandate like RBI forced NDSO?
Okay, so I think first point was the point that I was making earlier, that we should start thinking about any platform for corporate bonds in the line that we have for equity markets today, which is that you have designated market participants, and all investors, be it institutional or retail, are going through those designated market participants, putting the orders in an anonymous order matching platform, which is what CCIL predominantly is. Although CCIL does not have designated market participants, investors there are directly dealing. So you can have a dual mode for whoever wants to do whichever way. I will just step back and also make this point that don't try to copy paste what you do in more homogeneous markets like equity and G6, because those markets are extremely homogeneous when it comes to the nature of this ISIN, right? In corporate bonds, you can homogenize to a certain extent. For example, you can be very, very homogeneous when it comes to AAA PSU securities in terms of security structure, etc., 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 holiday conventions, etc., etc., things like that, and you can go ahead and homogenize that market. The easiest market to homogenize in the non-PSU AAA space is actually the money market. So if you want to have an experiment in terms of moving this platform online, start with the money markets, because that is the most homogeneous market. The pricing is fixed in the sense how you price it. There is no anomaly. The instruments are very easy to understand, and you can easily shift it. You just need the same phone market today to shift there in the same form and shape. You need to build in risk measures around that, which we can all talk about, but that's the easiest market to shift. So start with AAA PSUs and money market instruments to start with. And once people get confidence that yes, this market works, then the market will automatically start branching out. But I don't think even 10 years down the line, you are ever going to make corporate bond markets homogeneous enough for it to behave like a government bond market. The other thing is also that I think in the grander design of things, we should actually look at the bigger picture. So I'll just give you one example. The same corporate issues a bond which is non-bankable, and the same corporate issues a bond which is bankable. The same corporate issues secured, unsecured, wo to theek hai. Senior, subordinate, that is also understood. But how can one risk be a bankable risk and the same risk be a non-bankable risk? So at some level, you need to start thinking about those things. And then there is a pricing difference also. And there are two bonds of the same credit risk trading in the market at two different levels by two different set of players in the same, forget retail market, in the same institutional market also. So I think when you think about these things, you actually need to sit back and tick all the boxes. You can't tick 3 boxes and say this will work. That's point number one. But let's start with the more basic things, which is AAA PSUs and money market. Let's make a success out of that and then move to the more esoteric things.
That makes sense. Thanks for that. So Rohit, we put you on the mat now, finally.
Okay.
All right, so the point is, see, NSE has everything going from what one can say. You have bulk of the trades happening. You see, all the ISINs, everything is there, right? Why is it then that, genuine trades are not happening? Why, how do you convert this into genuine trading activity, like you guys have done so successfully for equities, right? Of course, there are factors, maybe without going too much into that. So, is there something which can be done, or NSE is doing, to genuinely convert this into real liquidity, real trades, actual transparency, actual price discovery and stuff like that?
Right. So see, two aspects that we are trying to address it. One, obviously, not all participants are there. So banks, which hold most of the corporate bonds, PDs, which hold most of the corporate bonds, they are not mandatorily, forced to actually trade on RFQ. So what happens is that liquidity gets, like he was saying, liquidity is scattered. So I think we need to have, maybe if it is pushed down from the regulator, like it happened in India's home, you make everyone come to the same platform, make everyone mandatory to do it. Then you will probably have it. The other challenge that we thought, and we spoke to a lot of participants, is that it is not anonymous. So today I know I don't want to trade with him, but I want to trade with him. And when we thought that what is the solution for this as an exchange, can we provide an anonymous trading platform to participants? It's about the credit risk, right? And then we said, can this model work where, you have margining, where you probably get guaranteed settlement of an anonymous trade to the extent where you probably have the margin from? And will that be a better thing? Because what also happens is there are a lot of rules and regulations which actually don't allow an SBI pension fund to trade with SBI mutual fund, right? So if that becomes an anonymous platform, then you basically pool in a lot of liquidity, and that is where we are trying to, work in terms of giving feedback, in terms of getting some things in place so that the liquidity pool is there together. And there is a regulatory thrust that everyone has to participate in this. And what will also happen in this, and I draw a very big parallel in terms of the FX when it happened in 2007-8, you had a lot of platforms, platforms, and every trader was very much worried that, my transparency will be shown to the other guy and I will lose my business. But what that actually did was, when the liquidity pool came to those platforms, the volumes just quadrupled. And then that fear of, me losing money was away. So I think when that liquidity gets pulled in, whether it is through the regulatory push or others, and you let everyone trade the same thing, it kind of pulls. And from that perspective, the platform is there. See, from a scalability perspective, from, in terms of everything, we already kind of planned for the next 5-7 years. So that is good. So that's what I think probably should happen, and it will kind of come through.
So thanks, that's useful. I think as far as the topics were concerned, we are done. Do we have time for questions? No? Everyone's gun shy?
Being probably the least familiar with the India markets relative to the US market, the two bonds, the same credit, same tenor, trading at two different levels, is it a different structure, or are they just one is and one isn't? You had mentioned.
Yeah, one is bankable, one is non-bankable. There are end-use restrictions in terms of what banks can fund.
I wasn't. I thought I heard that, but I wasn't clear. Thank you.
Should we then move on with the program, if there's no question? Okay.
Thank you.
I'd like to thank all the speakers and Manoj, of course. I'd request all the speakers to remain on stage for a couple minutes, and I'd like to invite Aditya to come on stage and give our speakers a small token of our gratitude.